Hey everybody, Stephen Green here. I wanted to do a quick video on the difference between a collateral charge mortgage and what it means, and the difference between that and a conventional mortgage. Now, I'm going to give you the bank answer. If you want more information from a legal standpoint, obviously talk to the lawyer that's representing you in the transaction, but the podcast that I have, the Green Effect podcast, I did release an episode in October 2018. I had Tyler Horty on, who's a lawyer partner of mine, and he actually goes into detail as to what the legal side of the difference is between the two. So if you get a chance, make sure you do tune into that podcast and listen to what Tyler has to explain. So let me give the difference between the two. When we do a conventional mortgage, okay, that's just again, lack of a better term, a regular mortgage. You pay down what you owe the bank, principal plus interest in your payments, and the amount of the debt towards the house becomes lower. Now, yes, it's called a conventional mortgage, but the bank still does take a charge, okay? So how much of the house the bank owns of yours, we still take a charge against the property, okay? With a collateral charge mortgage, it's a little bit different. So with RBC in particular, we have what we call a home line plan. So with a home line plan, let's say you're purchasing for $500,000 and we approve up to 80% loan to value, which is the maximum, 20% down of $400,000. What ends up happening is as you pay down principal on the mortgage segment, you have a line of credit that gets bigger based on the principal reduction. So there is a bit of a feature with the home line plan. Having said that, the home line plan is what we call a collateral charge mortgage. So when we do your purchase or your refinance or your switch or whatever it is that we're doing for you, you, the client, will have a choice. Okay, and I think RBC may be very close to unique in this. I don't want to speak to that, but I think it is a unique thing. So you have a choice. You can have the bank take a collateral charge anywhere between the home line plan limit, in this case $400,000, anywhere between that up to and including the purchase price or the assessed value or the appraised value on the property of $500,000. What does this mean to you? So let's just say you allow us to take the full collateral charge of $500,000. Later on, you want to refinance, pull some equity out. You're an investor, right? You want to pull equity out of your investment properties. If we take up to the 500, you can refinance up to that 500, so increase the home line plan limit, assuming the asset increases in value, up to 500,000, no legal fees. There will most likely still be an appraisal fee, but you're going to save yourself anywhere between $500 and $700 just in legal fees. Okay, so as an example, if your asset has now increased to 600,000 a few years down the road, hopefully sooner for some of you, and you want to increase the home line plan to 80% of that, which is 480. We can do that because you're within the 500,000, no legal fees. You still have to be approved, application, appraisal, the whole bit, but you don't have to pay the extra legal fees. Okay. Another part, if we take the full collateral charge. If we take the full 500 and your asset doesn't increase a whole ton and you want to go get a second position mortgage at another institution, another bank, lender, whatever, you can't. We own the whole house. So you're stuck with whatever bank has done it. So that's one part of a collateral charge and the actual amount. If we only take the actual home line plan limit, okay, of 400,000, pros and cons. If you want to refi later, we can still do it. Same thing, application, appraisal, etc. But you're going to have to pay legal fees. So $500-700, okay? On the other side, if you want to get a second position mortgage elsewhere, you can look at that, assuming your asset's gone up in value, right? You can look at that because we only own $400,000 of the house. So there's pros and cons. What this really comes down to is planning. Generally speaking, investors want the maximum amount of mortgage and they want to refinance later, pull equity out, a lot of stuff like that. If you're owner occupied, we got to ask some questions. What are the plans? Are you doing renos on the house? Do you think you'll need more money for kids to go to school? Or whatever the case may be. So, I think the solution is there, the product is there, but there's some questions you have to ask yourself, okay? If you do need, if you have more questions on this, please don't hesitate. Reach out to myself. If you do want the lawyer side of it, again, my podcast has that. But also talk to the lawyer who's completing your transaction, okay, and make a decision from there. It is an important one because it could impact, again, some fees later on, but definitely I think the planning is important with this. Okay, thanks so much. We'll talk to you soon.